So value and a growth combination. Now let me tell you in this tutorial that how to possibly find a stock that's a combination of value and growth investing. So the method that I'm going to tell you is a good approach for beginners which will help you in finding some good stocks, but this is again a basic approach and you may want to dig a little deep in order to find stocks that could multiply your income greatly. But nevertheless, this is still a good approach, a good method which will help you in finding some good stocks. So now let me just tell you about it. So first of all, you should always look for screeners. Now, in order to find stocks, you should use stock screeners. And you have to have some stocks to analyze, and that too good ones. So what should you search for in those screeners is some queries that I am going to tell you about. But first of all, if you don't have any knowledge whatsoever about the screeners, then let me tell you that these are actually stock filters, which means that you put some queries in them and these screeners filter out all the companies listed in stock market based on your queries. So for example, you put a query of net profit growth rate greater than some 30% or so for the last 5 years. Now this means that every stock that's past 5 years profit growth rate is more than 30% will show you in your list. Also, you can use various ratios to filter out companies, so that will pop out a bunch of companies with your specified ratios also. And that's really helpful because you don't manually search for all the companies that you want according to your specific criteria. So in a nutshell, always look for screeners and always look for companies with the queries that I'm going to tell you about. So the first query you should always put is debt to equity ratio should be less than 0.5. So what basically debt to equity ratio tells is that how much debt a company has taken in proportion to the equity it has. Now I told you about debt and equity, so let me just focus on this ratio as of now. So companies are considered to be risky if they take on more debt, at least more than half of what the equity the company consists of, because a company can take on more debt to finance its growth and it can grow, but then the company becomes a risky bet because you have to pay interest and you never know when the economy can go into recessions. Also, when the product piles up and nobody buys the excess supply the company has, and sometimes all of the factors add up. So a good company is expected to finance its growth by the money that it earns or the money it has already acquired. So a company taking on more debt is not a big deal. Everybody takes that. But a company taking on more than half or more than its total equity is considered to be a risky company. And you should always avoid those companies. So the debt to equity ratio should always be less than 0.5. Now the second query you should look for is return on equity should be greater than 15%. So equity is equals to assets minus liabilities, but it is also considered the money the shareholder invests in the company. So if a shareholder invests some money in the company, he expects to get some return on that money. And same goes for the company. When the company invests in some project or in some product or service or anything, then it expects some return on that investment also. So the money that shareholder invests in that company is in turn invested by the company in some product or service, and the return on that investment is called return on equity. So what is the right ratio you should set for in the screener in filtering out some good ROE companies? Well, a company is considered to have at least ROE of more than 15%. Actually, I would not call very good, but at least it's a respectable ROE. And any return less than that is unacceptable, because if the company is not even earning 15% on what it invests, then it's not a good business anyway. So you should always include another query of ROE of greater than 15%. Although you can increase the ROE percentage like 20% or 25%, and also look for the previous year's ROE, but at least 15% or greater than that, or whatever you like, but at least 15%. And the next query you should put for is net profit growth rate greater than 20%. Now, this one is self explanatory that net profit growth of a company should be greater than 20%, because mostly companies growing at least more than 20% are considered to be growth. Of course, you can go for greater than 30 or 40%, but at least 20% and not anything less than that. Although I would recommend to be growth rate that is greater than 20% and 30%. And also look for consistency, because also I told you that consistency is the key with the profits. Profits without consistency are nothing. So profit growth rate 20%, greater than 20%, or greater than 30%. For the past 3 years or for the past 5 years, the company is growing at greater than 20 or 30% is the thing you have to look for. And this is the third query you should look for. So next is small companies. So as I told you that small companies have the potential to grow the fastest, and that's why you should consider small companies. So in a screener, you should filter out companies whose market capitalization is less than $300 million. Now, this is a bit tricky because students from different countries are watching the tutorial, and as far as I know, the last time that I saw, students from 105 countries was taking this course. So it would be really hard for me to tell you that what is a mid and market cap in your country. And I seriously don't know about all the countries' stock market. So what you can do is search for the Google and find out the mid cap and small cap companies in your country. And then you can find a list of all the companies that are small caps or mid caps. So always look for those kind of companies in your country, because you see, a company that is small cap in American stock market is mid cap in Indian stock market. For example, a $300 million market cap is small cap, but $150 million market cap of company in Indian stock market is considered to be mid cap. So market cap definition changes from country to country, and the easiest possible way to look is search for Google and it will show in the very first page. And the last is price to earning should be less than 15. So I told you guys that you should always look for cheap stocks, but I didn't tell you what was cheap and what was expensive. Actually, I was going to tell you about that in this tutorial. So first let me tell you and clear out what is price to earning, and then I will discuss about cheap and expensive. So price to earnings is basically a ratio that explains the price that you are paying for a stock compared to what the profits of a company are. So if you are paying a price of $100 per share and the profits of a company, or the EPS, which is basically profits of a company divided by the number of shares outstanding, that's EPS. So if you are paying $100 when the EPS is $10, then you are paying a PE of $10, or simply 10, you can say that. That means you are paying 10 times earnings. And that's basically a price to earnings ratio. But now let me tell you about what is cheap and what is expensive. So actually, according to some well-established or respected investors like Phil Fisher, nothing is too cheap and nothing is too expensive. It all relates with how great a company is or how fast it is growing, and also the quality of the earnings. So the thing is, if you buy a cheap stock, and I'm going to tell you what cheap is, but again let me just tell you what big investors mean. So when people buy cheap stocks like price to earnings of less than 8, 7 or 6 or maybe even 5, then they think that it's a real bargain. And when the company's PE goes to like 35 or 40 or 50, then they think that it's a quite rich valuation and they consider those stocks expensive. So, actually, what these investors say is when the company is not growing or making even losses and all things are going against them, then even PEs of less than 7 or 8 is high for them because the company is in losses. So there's no point paying current price also. They are not considered cheap, they are in fact expensive. But on the other side, when a company has a PE of 35 and company is growing at a 60% growth rate, then the company still is considered to be a bargain even if its PE is 35. So there's nothing cheap or expensive per se. If the company is great and growing at a healthy rate, then you should pay reasonably. Although not too high. I mean, of course, the company is good and you can pay a price, you can pay a higher price, but yeah, you shouldn't pay too high a price when considering the company's fundamentals and future prospects. So, in a nutshell, savvy investors tells that nothing is too cheap or expensive based on a certain ratio or some figures. You have to analyze the company and then you can tell whether the company is cheap or expensive. But in a traditional sense or in Wall Street, people usually find stocks cheap when companies trade for a price to earnings for less than 15 or 10. So, as we have put a query that a company must be growing at least 20%, so you can put another query that a PE should be less than 15. Although not a guarantee bargain, but it still figure out a bunch of good companies. So these were all the queries that I just told you, and you should put all these queries in a stock screener, which will give you a list of some good companies which you should further analyze to better able to understand the company. And actually I told you that there's no set formula for investing. I could have told you to look for management modes or competitive advantage or DCF or discounted cash flow method and bunch of other things that you don't know right now because you are a beginner, and considering the fact that this is a beginner's course, I believe you don't know anything or you don't know any of it. So it doesn't make sense to tell you all about that. So that's why I told you another approach which you can understand in a better way and that could help you. So try this approach, use the screeners and filter out a bunch of companies. And so that's it for this tutorial. But if you have any doubts or you want some clarifications on something, then please do comment in the discussion forum and I reply to each and every query and I will get back to you as soon as possible.